Our first guest out of the gate on cash flow today says that oil could shoot up even further and has been doing a vulnerability assessment about who's affected more by the crude reality that we're undergoing right now and who's perhaps a little more immune. Johanna Chua, Chief Economist Asia Pac at Citi, joins us on the show today. Hey, Johanna.
Hi, good morning.
Okay, I filled up my tank the other day and a liter of 97 octane premium, $17, up from like 14 a few months ago. It hurt, but I wasn't going to say, okay, I just want half a tank because I got to keep going. So I paid.
Well, you're lucky you're in Hong Kong, and Hong Kong's economy...
That's lucky?
Well, Hong Kong's economy relative to the rest of the Asia is not as oil-intensive. I mean, this is a very service-oriented, diversified services-oriented economy. So although oil obviously is a negative, the overall impact on the economy is much less. We do find quite a few more countries in Asia that are much more oil-intensive, i.e. countries that are very heavy industry, in certain industries like petrochemicals, etc., tend to use more oil per unit of output. And therefore, these countries are a little bit more vulnerable.
You mean oil is a bigger component of
yes,
each unit of
output produced.
Okay.
And this depends on the type of economy you are. If you're more industry as opposed to agri or services, you tend to be more oil intensive. It also depends on the type of industry you are. If you're sort of the more sort of clean energy type of industries, you're okay. But if you're an industry, iron and steel, certain heavy manufacturing, you tend to be much more oil intensive.
We're talking, in this case, Hong Kong is made up of mostly suits and overpaid bankers.
Services.
So we're talking about like countries that make a lot of stuff like China, right? Very oil intensive.
Well, it depends.
Taiwan, Korea,
Thailand, because of the huge chemical industry. Petrochemical is also very oil intensive. China is actually in the middle of the range on oil intensity. But if you include total primary energy consumption, which includes coal, then China is way up there. So it depends on how you define which particular components of energy is much more vulnerable.
You know, Oriel, Australia has to be very oil intensive. I got on a Grey Line bus. My wife made me go to Phillip Island, south of Melbourne, to see the penguin parade. The little penguins returning after sunset to the little burrows in the hills. That was a 2-hour drive to see little birds. They're wonderful, don't get me wrong, but it was a 4-hour round trip, though. That's really oil intensive.
Yeah, well, that's oil intensive, but you've also got to look at all the mines and the resources we've got. Johanna, is that right? I mean, how does Australia sit on this global scale? Because, I mean, you're talking China, middle of the line. I mean, where does that put Australia?
Well, we haven't actually included Australia in our analysis because Australia is not part of emerging Asia, but Australia is cushioned by the fact that they're a huge exporter of commodities. And to the extent that a lot of commodities are very correlated, at least on the terms of trade front, they're not as vulnerable. Now, in Asia, you can't say that the same. So it varies a lot. If you're Malaysia, you benefit a lot from the external shock, the positive terms of trade shock. If you're Korea, Thailand, India, you're a relatively larger net importer, so it's more negative on the terms of trade shock. China is also a small net importer, but again, it's kind of not as severe as some of these other countries.
Adam Bakhtiar, our correspondent at the SGX in Singapore, is very oil intensive. Little Bird told me he tools around Orchard Road in a Maserati during the weekends. He has this need for speed or something. Right, Adam?
Far from it, Bernie. I'm shuffling around Singapore on this MRT train, so largely because the price of oil in Singapore is so expensive. But let's talk about the neighboring country, and if I get your take on this, Johanna, in terms of the oil intensity and where Malaysia sits in terms of that hierarchy, because as far as I've read, Malaysia seems to be the only exporter of oil and gas in the Asian region, and lately Petronas has had a massive find in terms of natural gas and oil, and keeping its reserves well into double-digit decades from here on in. So how does Malaysia look?
No, so Malaysia definitely is a standout in Asia, which is why when we're sort of looking at our outlook and what it means for currencies in Asia, sort of the ringgit is relatively better off than some of the other currencies like the Korean won and the INR. So yes, Malaysia stands out, but I have to correct you. Actually, the other country that actually has improved production in the last couple of years and has, in terms of trade has been more positive is Indonesia. So oil and gas in Indonesia actually now is almost close to balance. In fact, I think in 2010, it's a teeny weeny surplus because of the gas. Weenie surplus. Because the gas is a little bit larger than the oil deficit. But in Indonesia, if you add the coal, production and the coal net exports on coal, then actually Indonesia is slightly positive. But of course, not in a sort of similar range as what you see in Malaysia.
It's a fine line, Oriel, between teeny weeny and teeny weeny weeny.
Yeah.
It's It's a very fine line, a very fine line. But Johanna, let me ask you about that fine line, because you've done this vulnerability study, so clearly you've been watching the price of oil. At what point is this really going to start having a significant impact on economic growth in these countries that we've been talking about? At what point does the price of oil move to a level where you stop and go, okay, we need to actually intensify this vulnerability study and look at it in more detail?
Well, it's, of course, a big concern here is not only the level of increase, but how sustained the increase is going to be. And our estimates show that if oil price sort of roughly stays at around $120 to $125 a barrel on average for the year, then this oil shock will be as severe as what we saw in the first part of 2008. So we're not quite there yet, but obviously the recent trends are not very encouraging. And I think one of the other things that we also need to focus on is how that impacts global growth, especially in the West. If the U.S. Sort of growth recovery or the European growth recovery somehow gets a little bit more affected by this, that could also have an impact.
We've been there, though. We've been at 100, almost 150 a barrel, and it came back down. The fact is, we've got the Mideast problem. Libya has been out of commission for a week or whatever. But even, cities held by opposition forces know that they need that revenue, and they're resuming oil exports. When hell might be breaking loose in a lot of ways, but when things settle down, money will talk. They're going to start pumping again, and that'll bring it back down, so it may not be sustained.
Well, yeah, that's hope. That's our hope. That's our assumptions. We haven't made any major downgrade or revisions in our growth forecast, so our expectation is this is a, relatively manageable, short-lived phenomena, but we have to watch. And the other key important thing we need to watch is, central banks in Asia might be a little bit more sensitive coming into this cycle because growth and inflation momentum in Asia is relatively strong going into this oil shock. So therefore, we need to look at what the policy response could be on this oil shock, because some central banks may need to tighten a little bit more to address demand-driven inflationary pressures coming from the supply shock.
Which will lead us to our next topic, of course, on the show, and Oriel will take that up after the break, which is how skittish are the central banks. Johanna Chua from Citi will be staying with Cash Flow.